A currency pair surges upward, green candle after green candle. The momentum feels unstoppable, pushing you to click buy. And then, the floor falls out. You are trapped in a whipsaw. You bought into the absolute peak of the surge, and the market instantly reversed course, burning through your capital on the way down. These sudden, violent corrections happen because extreme price spikes are often fueled by emotion. Greed drives the market to an unsustainable peak, and profit-taking, or fear, triggers the sudden crash back down. Chasing that emotional momentum in a choppy market is a statistical trap. To survive, you have to stop reacting to the hype and start relying on a strategy built on mathematical gravity. This gravity is the principle of mean reversion, the statistical tendency for asset prices to eventually return to their long-run average level. Price action behaves like a rubber band. A surge stretches price far from its baseline, building statistical tension. For Forex, this baseline is the 20-period simple moving average. Eventually, momentum exhausts and price snaps violently back to the center. Since that correction is a statistical inevitability, survival depends on measuring the exact threshold where the tension is most likely to break. To identify that threshold, we use the Commodity Channel Index, or CCI. It is an oscillator designed to calculate how far a price has deviated from its statistical mean. The CCI line fluctuates around 0, bounded by positive and negative 100. Moving above 100 means the market is overextended to the upside. Conversely, dropping below negative 100 signals an oversold market, pulling heavily from the bottom. However, hitting these levels is not a signal to trade. These extremes are simply an early warning system, telling you to prepare the trap for the coming reversal. Many traders fail here by trying to catch a falling knife, buying the exact moment the CCI hits an extreme. That a powerful trend can keep the CCI at these levels for a long time, crushing anyone who enters too early. Wait for momentum to break. Short entries trigger when a candle closes and the CCI crosses below positive 100. Longs trigger crossing above negative 100. Place a stop loss beyond the extreme swing high or low and exit at the 20-period moving average. By tying your entry and exit to these specific mathematical crossings, you transform a chaotic reversal into a repeatable algorithmic protocol. While the CCI is powerful on its own, professionals look for confluence, multiple independent signals that validate the same trade idea. An A+ setup occurs when the CCI crossdown happens exactly as the price hits a historical resistance zone and prints a bearish candlestick pattern. You aren't just following a line, you're following a weight of evidence. But the system only works if the context is right. Fading a parabolic, news-driven trend is a recipe for disaster. In those moments, the market can stay overextended much longer than your account can stay solvent. Deploy this system in ranging markets or to time pullbacks within moderate trends. This is where the probability of a snapback is at its highest. The CCI is a tool, not a crystal ball. Success requires the discipline to know when the environment favors the math and when to stay on the sidelines. Mastering CCI mean reversion allows you to stop reacting blindly to market noise and start exploiting statistical inevitabilities. Capturing these reversals before the gap closes requires low-latency execution and tight spreads, ensuring your orders fill at the precise levels the strategy demands. Stop guessing and start testing the math. Open a demo account on the FXNX platform, load the CCI, and backtest your statistical edge today.